The DuPont identity. Why is the DuPont identity important to understand? It's important because it's a method that helps analysts better understand what is driving a company's return on equity, and it breaks down ROE, return on equity, into three basic components to do so. It breaks it down as profit margin, which is a reflection on operating efficiency, asset turnover, which is a reflection of the efficient use of a company's assets, and leverage, which shows how much a firm relies on lending to drive profitability. The DuPont identity recognizes that it is important to understand how a company efficiently manages its assets to generate sales and how well they use debt to produce returns. Using the DuPont identity allows analysts to dissect a company to determine whether their strengths and weaknesses lie and helps them quickly identify areas to look into for more details. It identifies both balance sheet measures and income sheet measures. And since return on investment can be manipulated by increasing a company's leverage through boosting, increasing and boosting leverage will increase a company's return on equity. Since a company's return on equity is an important profitability metric to shareholders, it's important to reflect this number, and using the DuPont method helps look further into details to make sure something like this isn't happening. Since the DuPont identity involves breaking down key financial analysis ratios, let's just take a quick look at their role in accounting. Financial ratios link together information from two of the three main financial statements on a company: the income statement and the balance sheet. By doing this, it gives a more realistic view of a company's performance. One of those ratios is the return on equity. It's a financial ratio that's defined as net income divided by total assets. Basically, the net profit of a company is divided by the shareholder value in a company. It shows a relationship between net income availability to common stockholders and their average common equity invested in the company. I mean, at first glance, you would say that the higher this number is, the better the company is performing. But ROE is more meaningful when you look deeper into the underlying components, which is what you can do with the DuPont identity. And you can ask questions then like, what made the ROE go up or down versus the prior year looking at the same company? Or why is the ROE for two separate companies in the same or different industries different? And like I said, the DuPont identity helps better answer those questions. The DuPont Corporation expanded the concept of ROE to express it as the product of profit margin, asset turnover, and a measure of leverage. They basically further expanded the equation to identify sales and assets as well. Basically, when you're multiplying a fraction bars and the numerator in one fraction is the denominator in another, they cancel out and they take us back to the reduced fraction of net income, in this case, divided by equity. Now, the first element of the DuPont identity is ROS, which is return on sales. This is the net income divided by sales. It's an indicator of the relative profitability or operating efficiency. Basically, how many cents of profit are generated for every dollar of sales. The higher the ROS, the better. The second element is asset turnover, which is sales divided by assets. This measures the asset use efficiency of a company and enables analysts to determine if we can maximize the amount of sales we generate with the assets we have. And from here, companies look at maximizing sales by asking questions like, is manufacturing operation or supply chain operation efficient? What terms are we negotiating with our customers? Are customers currently paying on time? Answers to these questions will assist a company in minimizing the amount of inventory and stock they have during a period, which is basically minimizing the denominator of the asset turnover equation. Now, when we break down the first two components, we can then determine return on assets for a company, which is basically multiplying the return on sales times the asset turnover. Some companies will call this ROIC, ROTC, ROCE, RONOA. But they all look at the same thing. They look at the returns, profits generated, and compare it to the capital invested in the company to generate the returns. ROA is an indicator of business success. Now, the last part of the DuPont identity is leverage. It's sometimes called the equity multiplier. It's basically assets divided by equity. Whether this ratio should be high or low is debated by many in the industry, because if an organization is able to take on debt at lower interest rates and manage it efficiently, they can grow the company faster while generating higher returns. However, if debt is relatively high compared to equity in a company, this will increase a company's risk profile. It'll increase their risk of bankruptcy and have it labeled as being a highly leveraged company. Now, let's apply the DuPont identity to the following example using the data from Big Bang Incorporated's balance sheet and income statement from the year 2017. Now, using this formula, we can calculate that the return on equity for Big Bang in 2017 was 40%. We did this with the DuPont identity by taking profit margin, multiplying it by the asset turnover, multiplying it by the leverage factor, which gave us 40%. Now that's a quick run through an example of the DuPont identity. But as you've seen from the use of financial ratios and the use of the DuPont identity, accurate and honest bookkeeping has an effect on a company's reputation, its obligation to its investors, and its creditors. However, some managers have been known to use accounting methods to show little debt on their balance sheet, which artificially makes these ratios look more attractive to investors and lenders. By using a technique that's called off-balance sheet financing, a company can hide expenses in research projects, purchasing through leases rather than reporting assets, or putting them into joint ventures. This lessens the reliability of a company's debt structure and gives a misrepresentation of the true debt a company has. Now, asked to use these types of techniques, one needs to be reminded of what Paul says in Romans. Pay to all what is owed to them. Taxes to whom taxes are owed. Revenue to whom revenue is owed. Respect to whom respect is owed. Honor to whom honor is owed. That's Romans 13, verse 7. Respect and honor is due to those who invest in a business and lend it money. Honor and respect should keep us from using techniques to hide the true debts of a company and report those who ask us to breach these ethics to upper management.